So Jeff, what are the quantifiable elements then that really make this emerging markets a long-term story?
The driver of the long-term cycle is typically investments, right? So investments typically take a 5-year or more cycle. And why is that the case? The key is in the behavior of individual companies. A company typically won't do CapEx, won't open a new factory until it sees 1 or 2 years of good business, good pricing. It wants to see its existing factories fill up. Once it's decided to build a factory, it takes another 2 or 3 years to plan and build a factory. So by that time you reach year 4 or 5, suddenly all the factories are being opened, prices come down, and the cycle ends again. So where are we in this? We had a downturn in investment lasting for 5 years from 2010 down to 2016. And finally, we're just beginning to see CapEx bottoming out. We're just beginning to see the factories, they're not full, but just beginning to get a little bit busier. Margins is just beginning to rise. When we go down and talk to CEOs and CFOs, they confirm this. Anecdotally, they tell us, yes, we're considering CapEx. So it's going to take another 2, 3 or more years for them to actually to implement all this CapEx. And their actions doing that will actually continue to drive the cycle and hence drive the equity returns as well within EM.
So Jeff, could you talk through us an example of an investment in your portfolio that brings to life this boots on the ground research that you talk about?
Sure, absolutely. I'll talk about an old economy stock just to show we're not all invested in growth stocks. One of our holdings is POSCO, the Korean steel company. We've avoided steel for years and years. For the last 2 decades, the problem with the steel industry has been overcapacity in China. So China has been building many, many steel plants. In 2017, they began to change their policy. They realized that these small steel plants that have been dotted all around China were subscale. They produce pollution. They're not profitable, they cause non-performing loans for the bank, and they went 180 degrees. They started closing capacity. And straight away that caused steel prices around the world to rise. Right? So this became very interesting. POSCO was at the time selling for about half of book value, very cheap. Half of book value, which would basically say the market is thinking they're not going to earn their cost of capital in the long run. There was some skepticism in the market about these supply side measures by the Chinese government. The feeling was, oh, they'd put a close sign on the factory, but the moment the pressure's off, they'd come and reopen the factories again. So we went down to the ground, right? We can't just break into a factory and see if it's operating or not. We talked to the local bank managers and said, hey, can you help us to visit this factory? And so we actually went down into individual factories to see that they're shuttered, to actually see that the equipment has been taken out. It's easy to put a lock on the door, but it's much harder to restart the plant if actually your furnaces have been taken out. So with that, we had the confidence that China was serious about supply side measures. We bought POSCO. If we are right and POSCO manages to earn its cost of capital, it could be trading at 1x book, right, which would be a doubling of the stock.